Hello, and welcome to the Consumer VC, where we're going to be diving into the world of venture capital and consumer-facing startups. I'm your host, Mike Gelb, and over a series of interviews, we're going to learn how early-stage B2C startups raise money and look into the inner workings of venture capital. If you enjoy this podcast, I would really appreciate it if you would write a short review on the Apple Podcast app and subscribe on your favorite podcast app. For all episodes, you can go to theconsumervc.com. Our guest today is Will McClelland, co-founder and partner of Elizabeth Street Ventures, an early-stage investment firm focused on the digital consumer and next-generation brands that improve daily life. He is also the co-founder of Bambike, a family business that builds bamboo bicycles and operates ecotourism activities in the Philippines. Prior to Elizabeth Street, Will was a partner at Grace Beauty Capital, a family office venture portfolio focused on early-stage consumer businesses. During his time as portfolio manager at Grace Beauty, he invested in Third Love, Harry's, Rothy's, Birchbox, and many, many more. I had such a wonderful time chatting to Will, and so without further ado, here he is. Thank you so much for joining me today. How are you doing?
Mike, it's great to talk to you. Thanks for having me.
Absolutely. Thanks so much for coming on. I really appreciate you taking the time. So what attracted you to invest in startups and travel from investment banking and hedge funds to then co-founding a bamboo bicycle company and just invest in startups in general?
No, absolutely. So I started with a more traditional path in finance as an investment banker working for Lehman Brothers in their Menlo Park office in Silicon Valley, focusing on tech companies. And this was back during the tech bust, I suppose, from 2002 to 2004. But I'd gone to Yale and I really kind of read a lot of David Swensen's books and was interested in what the Yale Endowment was doing in alternative asset classes. So I actually had an opportunity after a couple of years to go work for a fund of hedge funds in San Francisco called Ironwood Capital Management. And when I started at Ironwood, we had about, just over 250 million in assets under management in around the 2004 timeframe. And, over the 8 years that I was there, the industry grew, but then Ironwood grew to over $3.5 billion. And so I had started there as an analyst, but was eventually promoted to managing director of research, kind of overseeing the entire research function, and was also the youngest member of Ironwood's investment and risk committee. So, for the first 10 years of my career, I was very focused on kind of markets, but also trained as a very traditional investor. But we were looking at asset classes in the hedge fund space that were kind of non-traditional. So we were looking at things like distressed debt, merger arbitrage, convertible bond arbitrage, and strategies like that. So for me, I was always interested in these practitioners and these kind of investors that were doing things that were, very specific in nature and had very kind of, distinct return characteristics. And then from my seat as a portfolio manager, putting that all together into something that made a lot of coherent sense from an investment standpoint. And it was completely out of the blue that so I have a younger brother who for a time was living in our laundry room in San Francisco. And then he moved to the Philippines, where, we're dual citizens, and my brother and I are both half Filipino and have a lot of family there. So he'd moved over to Manila and then came back at a certain point and pitched me an idea that he had, which was to start a bamboo bicycle company. I thought it was very interesting and, suited him very well, but then he kind of explained to me that bamboo had higher tensile strength than steel, and that there was a guy making bamboo bicycles, and he had gone and learned how to do it, and that it was an abundant natural resource in the Philippines. It's actually a grass; it's not a wood. It grows extremely quickly, so it's good for the environment, and biking itself is good for the environment. So he kind of pitched me on his idea, and of course, your younger brother, you want to support him, and so I said, look, this sounds great, but why don't you write me a business plan? And so we did. And then, he presented it to me and we worked through it, and I wrote him his first check, which I was, fortunately in a position to be able to do. And, watching my brother go back with that, small amount of funding to the Philippines and turn it into the kind of booming social enterprise it is today. We make bamboo bicycles. We sell them to high-end resorts. We sell them, to consumers, but then we also run a bike tour business now in Manila, which is the number one rated outdoor activity on TripAdvisor, actually. And one of our bikes was given by the Philippine ambassador to the U.S. to President Obama as a state gift. So kind of watching this all happen and have it, kind of retrospectively thinking that was an idea that someone had, and then it was a business plan, and then there was a check, and then now it's become all these other things. I've been studying these asset classes, like I mentioned, convertible bond arbitrage, litigation claim investing. I mean, very kind of obscure, hedge fundy, off the run types of strategies. I thought to myself, well, is there an investment strategy here in funding? Obviously venture capital was something I was very aware of, especially living in the Bay Area and having friends in the industry. But I thought to myself, wow, funding consumer businesses, you're not only close to the entrepreneur, but you're close to the product and you're close to the end user. And so that was the first time I thought to myself that, consumer venture as an asset class could even exist as a viable way to make attractive investment returns.
Does it help when you are evaluating companies that you are the actual target audience?
I mean, I think it can be a good thing. It can also be, but I also think there's a skill in being able to abstract myself as an investor to look at many different classes of companies and many categories and at many different price points and tiers. So for example, if I was myself just a luxury consumer, not saying that I am, but say for example, I was in that tier of consumer, and I only invested in things that appealed to me as a consumer, then I wouldn't invest in things that could resonate with the mass market, and therefore I would be missing things and opportunities that could scale very broadly. So I think, yes, I definitely invest in companies with brands that speak to my own demographic and resonate with me, and certain brands in the portfolio where I very much, use the products, represent the brands, wear the merchandise, et cetera. But I think really good consumer investors can function at different tiers of price points, different categories, kind of more broadly. And then also, I'm certainly not a consumer of, women's products, but of the companies I've invested with that have been the most successful, I mean, most of those have been products that kind of cater to millennial females. So I'd say the answer is, for some brands, yes, they're suited to me as a consumer, but I think to be a very good consumer investor, you have to kind of abstract your own tastes from your ability to analyze something as an investment.
No, I mean, that makes a lot of sense. So how did Elizabeth Street come together?
Sure. So, like I mentioned, I had the experience co-founding Bambike with my brother, but I was still working in the hedge fund world at the time. And I, after 8 years working in the fund of funds, I decided that I was wanting to do something different. And through some, a lot of networking, some time off where I traveled a little bit and, thought about what I wanted to do, I really got interested to see if I could pursue this or, this opportunity in venture, knowing that, I wasn't going to walk into a venture firm and just get hired. I kind of had to find my way to break into the industry. And I felt that, working with a family office was probably a good way to try to do that. And just so happened that through a friend of mine that was working at a venture capital firm in the Bay Area, I was introduced to his brother-in-law, who's here in New York. And he and his father run a beauty distribution company called Grace Beauty. And they were very interested in investing some of the family's capital into startups and had actually already invested in companies like Peloton, Warby Parker, and Birchbox. We're looking for someone with an investment background like I had to come and continue to build out the family's venture portfolio. So in 2014, I went to go work for my old partners who, father and son. We created our, investment brand for the family office, called it Grace Beauty Capital. And then I kind of worked to kind of professionalize a lot of what we were doing from kind of the back end, everything you need to do to go source deals, build a network. I built and kind of managed a research group before. So a lot of my approach was taking on things that I had learned from that experience and applying it to being in New York, meeting with as many entrepreneurs, as many investors as possible, started sourcing deals, working with the father and son who were my partners and sometimes co-investing with them, but, built up a track record of, over 4 years investing in companies that were kind of, some DTC companies, CPG companies, saw a lot in the beauty space, obviously, because I was part of a beauty distribution company and operating business. And we did some investments in retail tech. And, some of those investments, like we were early investors in Third Love when they were doing less than $1 million of revenue. And we were early investors in Rothy's, which again was also doing less than $1 million of revenue back when we made those initial investments in both Third Love and Rothy's. And this is public information. Third Love did $180 million in sales last year, and Rothy's did $140 million in sales. And so, those were two of kind of the examples I speak to when investors are kind of unsure as to what the investment opportunity is, what the investment case in consumer. A lot of, some more traditional investors think it's a very niche place to be in. But, those have generated incredible long-term returns, and those companies continue to grow. So I had an opportunity to work with the family office, for 4 years. I built a track record, so invested in about 20 companies with my partners at Grace Beauty Capital. Built a nice, I think, narrative for Grace Beauty, really nice network for myself in New York as one of the, as someone that was interested in consumer. And again, when I started, consumer venture wasn't really part of the lexicon. I mean, we had tech VCs that were coming into certain consumer companies. There was, obviously a lot of growth equity firms that focus on consumer and some angels. But, when I would meet an entrepreneur, and at this point, I was an employee of the beauty company, and we sold to channels like Walmart and Target and Walgreens, and I would go to Bentonville and go to Walmart Supplier Day. So I really learned kind of the language of consumer from the inside. And when my partner and I would speak to entrepreneurs, it became very clear to them very early on in the meeting that even just the way we spoke, the types of questions we asked, how we thought about their businesses and, consumer brands was different than, their meetings and experiences that they would have with more traditional kind of tech-focused VCs. So that just told me that, my initial thesis that, consumer venture could actually be a distinct asset class, and I could actually form a particular framework that fits early stage consumer investing that's actually different from the traditional tech VC model. And, on top of that, the narrative and speaking the language of the consumer industry, it was just, it resonated with entrepreneurs. And then I knew it was something that probably could be an opportunity for something bigger and beyond the family office that I was working for.
What should entrepreneurs kind of pay attention to when it comes to if they're raising money from family office and having a family office as a partner, as opposed to maybe a traditional venture capital firm as a partner?
Sure. Yeah. No, I think every family office is different, and they say if you've met one family office, you've met one family office. They're all completely different. So I can speak to Grace Beauty Capital. Like we were very knowledgeable about, CPG retail distribution. And then we could kind of take that framework and help apply it to these next generation of brands that were starting in digital channels, but we're eventually trying to figure out how to do business with a Target or like Warby Parker open their own stores, et cetera. So I can't generalize about family offices, but I did find patterns in the tech VCs were actually very different than the growth equity, more private equity funds, in that the loss rate expectations for a tech VC are completely different than for a growth equity fund. And you'd seen enough examples of some more tech-focused funds funding consumer businesses, and in some ways, overfunding them and not having a great outcome from a return standpoint. That it became clear to me that there was just a different ethos when a company, because at the early stage we were kind of, the companies that we would, the entrepreneurs that we would meet were in consumer, kind of straddled the lines between VC and PE, and some would grow up and go west and get funded by those types of by those types of investors, and others would get funded by more growth equity type funds. And the growth expectations that were put on those founders and those companies were completely different based on the path that they had chosen, right? So I think the biggest generalization that I saw in my seat at the family office was that, A, because we were a strategic family office, we were, one, non-competitive to either the VC or the private equity fund, because we were just we were additive and non-competitive, and we weren't, we had smaller checks, and, we were just kind of good members of a syndicate that brought strategic value. But what I noticed by, having seats in both kinds of businesses was that, yeah, I mean, consumer companies, consumer VC actually is much more akin to like an early growth equity portfolio in many cases than it is in similarity to a more traditional tech VC strategy, where, a growth equity portfolio is not going to have any losses of any of their portfolio companies. And so they have, more moderated return expectations, call it 3 to 5x. But, VCs a lot of times are playing for the home run. So, they're pushing for growth and they're funding for growth, but they're also willing to accept, some loss rate of their portfolio companies. And so I think one of the interesting things was kind of watching that and kind of trying to educate founders about that in a way, to kind of coach them in a way where they could steer their paths to whichever routes that they felt was most appropriate for their business. And yeah, I got just a very interesting, over 4 years at the family office, I had a very interesting seat because, some investors would go one way, and some companies would go one way and others would go the other way. And, I was able to kind of form my framework based on my experience, watching that.
I really appreciate that response. I never really thought about consumer businesses and consumer brands in terms of the venture capital model as opposed to the growth equity model, which kind of leads into my next question, because I read an article in DigiDay, and according to CB Insights, consumer D2C brands have raised more than $3 billion since 2012, and half the money was raised in 2018. However, we really haven't seen a lot of exits for D2C brands in terms of there hasn't been many IPOs and only a few acquisitions. So how does this influence your approach to D2C brands?
Yeah, no, I think it's important to point out that at Elizabeth Street, DTC would be one piece of what we're looking at overall. I mean, we're looking at consumer in a way that encompasses everything from fintech to healthcare and hospitality and entertainment and CPG. But then, obviously DTC has been an area that I have invested in a lot. So I would say, one, DTC does not make a tech company necessarily. Every company needs to be selling online. And based on what your product is and what your product category is, that will dictate, what the right mix is, right? Apparel does very well DTC. But, food, up until now, like just isn't it doesn't do as much volume on DTC versus more traditional grocery channels. But within DTC, to answer your specific question, I would say you don't want to put $100 million into a DTC company to get out $100 million of revenue. That's neither capital efficient nor sustainable, right? And I think some companies experience that and are now examples for this next generation of entrepreneurs who have seen businesses like that, and the pitfalls with funding a DTC business in the same way you would fund an enterprise software business. It's just not a good not a good fit, right? But we had to kind of figure that out early on, especially in 2012, 2013. I mean, it was a new model, right? So the funding model really hadn't quite been figured out yet, and I think it's evolved. But I'd say you can still get exits. I mean, we were at Grace Beauty Capital investors in Harry's, which had $1 billion plus outcome, in Eloquy, which got acquired by Walmart, and in Peloton, which just went public. So you have to really look. You can't lump everything into DTC as the same. And I think that's where being a specialist consumer investor, when you can have a more nuanced view and opinion on what brands and what product categories and what types of businesses are more defensible than others, and what segments are more crowded and less differentiated, and you can kind of pick your spots. But I'd say just general talking about DTC, like I think we're gonna find that some DTC businesses grow from $1 million to $7 million to $20 million to $50 million and plateau, or they plateau at 75 or 100, but there's a plateau in a lot of these businesses. And part of it is because, rising CAC, right? Or it's not you're not in a winner take all market if you're in apparel, right? There's many players, there's more competition. So I think I always think about it in terms of the specific product category. And then what you can do is, it's not that the DTC model is bad in any way. It's just, I think you have to align, I think for founders, you have to realistically align your growth trajectory and where your brand might plateau in your core set of SKUs, and fund it accordingly, right? If WeWork's not DTC, but if WeWork was just happy to say we are an office space company and not a we company with we live and we gym and like we school, or I forget the name, but or if you're a luggage business and you stay a luggage business, that could be really good business. But if you try and boil the ocean and try and be everything to everyone, and own the market, I think some of these consumer companies will find out that consumer in many cases is not a winner take all market, like some more tech categories, which can be winner take all.
So what's your average check size at Elizabeth Street?
Sure. Yeah. Elizabeth Street's average check size is somewhere between $250,000 and $2 million. We'll write $500,000, $700,000 checks to companies with, at seed stage or less than $1 million of revenue. So we can be either a lead investor for a seed round or just a very important investor in a brand's early trajectory. But we've also done investments bigger than that through a couple SPVs that we've managed, over the last year as well. At
that stage, or at those stages, I'd imagine when you see pitches, you probably don't have a ton of data to go on. What types of qualities do you look for in a founder?
Sure. No, and I think it's a great question, right? And a lot of this, I learned for 8 years interviewing hedge fund managers. I think, these interview skills are one of the most important things that have carried over from my career in finance to working in venture capital. And I think what I've boiled down for me personally, two things on a qualitative basis about founders is, one, insight, and two, magnetism. And the insight piece just means that the founder has to have some special insight about his or her product, category, service, market, et cetera, that I can buy into. So I don't have to have the insight myself, but the founder needs to really have an insightful take on why they're starting their business or why their particular business can generate enough demand in a market where there seems to be, natural acquirers. And I kind of think it through like that. Part of that is understanding, how insightful is it, and does that lead to defensibility? Does it lead to differentiation? Is it just super early? Is it in a category that just people haven't really been innovating in? And every company in our portfolio, I can talk through exactly the insight that got me interested about the founders and the company. And two, the piece about magnetism, I think, is just a really great way to describe how hard the founder's job is, right? Because as the founder, you not only have to attract customers to your mission, but you have to hire employees to your company, and you have to also be constantly fundraising. So you've got to sell investors. So personal qualities of the founder, once they have what it is that is special that they're building, you have to be able to pull people into your circle. And the more magnetic the individuals are, the more you as an investor can project out, okay, this will resonate with a broad customer base. This is going to be easier, because it's never easy, but easier to raise capital for. And this is the type of place and the type of culture and the type of people that, employees are going to want to come work for. So I'd say those two things, insight and magnetism.
I really like that you raised talking about, competitive advantage and analysis. I was just curious as to what maybe are some perceived competitive advantages that people might think are competitive advantages, but you actually don't believe that they're a moat or a competitive advantage for a company.
Yeah, look, it depends. I guess it depends on the category. That's a good question. I'd say, look, brands, it's very hard to just compete on brands if there isn't some kind of technical component of your product construction or some particular reason that this set of founders or this business has some sort of moat around what they're doing. It can be very easy to copy and compete with. And so I think, founders that are unrealistic about that, I think are, you want to be cautious to invest in, because it means they don't have a realistic market map of their competitive set, which could lead to some bad things from an investment standpoint down the road. But particular attributes, I just think there's certain categories that are super crowded. Unless you find something very special, it's better to pass. So, I've seen a lot of beauty companies, and you want to pass on, 9 times out of 10, you're going to want to pass on, the beauty companies. I invested in Supergoop, which has done very well, because SPF, which is what Supergoop does, sun protection, is actually a very technical product construction, and it's harder for companies to figure out. And so fewer companies do it. But if you look at like deodorant, and I haven't invested in any deodorant companies, but, natural deodorant, better for you, no aluminum. I mean, Native is a brand that got acquired. Schmidt is a brand that got acquired. But at the end of the day, like, is there a high barrier to entry to start a new deodorant company? And if Unilever and P&G have each made an acquisition in that space, well, then what's differentiated about brand 4 and 5 and 6 in that category? And also, who's the acquirer, right? So I was trying to think through those market dynamics, and it could be just like some people have first mover advantages. Some people have a very technical product moat, or there's something about, there's some barrier to capital raising for a company that means that it's harder for other competitors to come in. But I think about it a lot, but it's something that's very kind of category specific.
When should a founder or an investor know when the startup has actually found product market fit?
I don't really use the words product market fit. I mean, I think it's because you can get product market fit on something that could be a very small niche opportunity, right? So it's less to me about product market fit, because there's a long tail of tastes and there's, and I try not to invest in these like longer tail types of, I try and look to things that can scale to a wider, broader mass, or, I call it masstige, which is that tier between prestige and mass, more aspirational segment, right? And so it can be very big. So I'd say it's very different to say if you have product market fit for, something that has just a very specific audience, or if you have product market fit in something that could literally, be worn by, or could be purchased by, the majority of Americans. So, look, early on, we look for, demand signals like revenue growth, social media engagement, kind of look for things that tell you about word of mouth communities being formed around specific brands, product reviews. There's a lot more information now for us to evaluate. So, I mean, I can read Amazon reviews, I can read product reviews. for companies that have less than $1 million revenue and get a pretty good sense for what people are saying. And I can look at the ingredients in a brand versus the ingredients of a competitive brand that's been around for a longer period of time and know, okay, this is really a healthier for you type of product. So, and then, you make your own, we think very thematically, right? So we have these top down kind of thematic themes and how we think about different segments of consumer. And, we try and find companies that are kind of building towards those themes. But, product market fit, I'm more concerned about the size of the market, quite frankly, than, fitting into something that's very niche.
To quote from you in Crane's New York business, if you want to start a tech business, go to San Francisco. But for more human-centric businesses, New York is more vibrant. Would you mind describing what you see as differences between startup ecosystems between Bay Area and New York? Because I know that you lived in both areas.
Yeah, no, absolutely. And I'll preface this by saying, some of my best friends live in San Francisco, and I spent 10 years there, and it's dear to my heart. I love it. But for many reasons, it's a lot smaller. It's less diverse, diversity of culture, diversity of industry, diversity of income. Well, today, certainly diversity of income strata, as compared to New York. And I think you just have a more broader set of industries that can that are adjacent to consumer businesses that can be more useful in terms of, who you're partnering with from a business standpoint, but also who you're hiring and what your talent pool is, right? So New York just has, look, we're the center of industry. We're the center of finance. We're the center, healthcare, beauty, fashion, commerce, consumer. It's just a much more diverse media. There's many more diverse industries here in New York City than exist in the Bay Area, and that's just a fact. So if you are building a high-tech business, and the success of that will depend on the engineering talent and the tech talent that you can get, then you should be in the area where, the most talent for that exists, which would be the Bay Area. But if you are, like I use this example a lot, like, look, if you're a female founder starting a consumer company, there are cultural differences, and there are lifestyle reasons that New York is just a much better city for you and your team, right? It's just a different, I think it just has to do with the diversity of the industries here, which means there's a diverse talent base here. And interestingly, there's just a much less developed kind of venture capital funding ecosystem here, which to me makes, Elizabeth Street's opportunity very clear, right? Like, we can be a leading, if not the leading consumer early stage investor in Lower Manhattan. And if Lower Manhattan is kind of our home field advantage, so to speak, and one of the reasons, Elizabeth Street is in Alita. It's a beautiful shopping street. Tory Burch's first store is there. It's up and coming brands are there. We can be that brand and work with enough founders that are attracted to that ecosystem and come here not only for capital from firms like ourselves, but for the other adjacent industries like the branding agencies, the media companies, the what's going on in food. I mean, it's just, there's a lot here to pull from, because not every business is a pure tech business. I mean, I say human centric because, consumer business at the end of the day has to sell to the end consumer customer, which is, humans have very, have needs, and they have, there's things that are culturally important. And so understanding, and being a part of businesses that can be culturally relevant, I think, is an opportunity that we have here in New York, which is just a different opportunity set than, perhaps what you would see in the Bay Area. And I think the other market where, that lends itself really well to consumer is LA.
Now, I know we spoke about New York, San Francisco. What's your advice for founders that might live in secondary or tertiary markets?
So one, come to New York and raise capital and visit us when you're here. But two, I would say, look, I mean, I think you can build great authentic brands out of, what we could call secondary markets. I mean, we just invested in the fastest growing hot sauce brand in natural grocery called Yellow Bird Foods, which is out of Austin, Texas. And we also invested in a DTC outdoor apparel company called Oros, which is based in Portland, Oregon. And I think those are two very good examples of, look, these brands have to authentically connect to their customers. And so hot sauce from Austin and a cult brand in Texas, which is, one of the barbecue capitals of the country, is like a very authentic brand, right? If you're making next generation, jackets for the outdoors using next generation technology adapted from NASA, well, being in Portland and with access to the Pacific Northwest is a great place to be, because your customers are there, people that, would come work for your company and live that lifestyle, that's where they're going to be. So I guess my advice is, look, if you're if you're not in New York or the Bay Area or in LA, build your business, but, connect with investors in those markets that have resources and networks that you can kind of tap into. So for example, Yellowbird in Austin and Oros in Portland know that at least through Elizabeth Street, they're somehow plugged into what's going on in New York and into the other digital brands here, into the ecosystem here. So you don't necessarily have to be here, but I also think, there's certain advantages too. It's harder to build an authentic outdoor apparel company if you're not in a city that has immediate kind of access to the outdoors. If you're building a organic hot sauce brand, it really helps to be kind of in one of the barbecue capitals of the country. So there are certain advantages to being in smaller markets, not to mention, obviously, cost of living, access to new talent, where young people are moving. And, Austin is an extremely exciting ecosystem, Portland for outdoor sports specific, definitely. And then, other cities for different industries, Boston for, healthcare and high tech too is, I wouldn't even consider Boston a secondary market, but yeah, I'd say, the advice to founders would be, if you're a consumer founder, and when you capital raise and you come to New York, speak to the consumer investors here, and they can be helpful by plugging you into their network.
Yeah, that makes a lot of sense. I mean, also as well for startups, I read an article about, since San Francisco and Silicon Valley are just becoming so expensive, it's becoming more and more difficult for some founders to start companies in that area. So as well as cost of living in terms of secondary markets. I want to talk briefly about round sizes and how they've increased dramatically over the past few years. Now we're having huge funds in venture capital, and now we have the pre-seed micro funds. How has this influenced you as an investor and think about price in today's climate, where it seems like valuation for startups just keep getting exponentially bigger and bigger?
Yeah, no, I'd say it's something we have to pay very close attention to, because, as investors in illiquid securities, price and diversification and asset selection are your three main levers to pull from a risk management standpoint. So price is a huge one. And, as early investors, I think the benefit that we have is that, prices are generally, they're pretty low at the seed stage. I mean, are they pushed up a little bit at the A? Yeah, in my experience over the last 4 or 5 years, they have been. But, we kind of have a target range of wanting to invest in companies with enterprise values between 5 million and 40 million. And we want to be able to earn a return of 5 to 10x on every investment that we make. So look, if that means we don't participate in a B because at the price of the B, we don't think we can make our 5 to 10x return, then we better, build our position in the seed and the A. Or if we do the B, we can do that through an SPV or, outside of our fund. But, generally early on, the prices for companies with less than $1 million in revenue are going to be more a function of how much equity the investors want to buy and the founders are willing to sell. And that usually falls somewhere between 20 and 30%. And so we kind of back into the valuations for that. And in consumer, for fast growing companies, you're kind of looking at multiple of sales. And so, you're still looking at things like 3 to 4 times revenue for, just kind of a rule of thumb. But yeah, prices get pushed up. And, that can be detrimental to companies too. I mean, raising a lot of money at a high value and then not delivering the growth in the next 12 to 24 months to justify that value can leave companies in a problematic position for the next fundraise if they're not profitable. So, it's something that we have to pay very close attention to. And if something's too expensive for us, well, then it's got to be a pass.
No, I mean, absolutely. I mean, in terms of companies raising too much and not delivering, I mean, I feel like I read about WeWork all the time in the past few days. So it's definitely an interesting landscape today. What are some consumer trends that you're most excited about?
Yeah, so I'd say one of the trends that we've been active in with a couple of our companies, that maybe traditional tech VCs don't really get interested in about is this kind of growth of the experiential economy, and coupled with the turnover of traditional retail and kind of falling commercial rents, right? And so, retailers like Barney's, Forever 21, here in New York, Dean and DeLuca, going out of business, and they leave these huge kind of retail footprints kind of in quote, high street locations, right? So in the middle of the greatest city, one of the greatest cities on the planet, you've got, huge kind of vacant spaces. And, we've invested in two companies that have different business, that aren't retail-based models that can actually make use of like very large, like 25,000 to 30,000 square foot spaces. And so I think thematically that's something that's playing out because of what's happened. It started obviously with digital shopping and e-commerce and how that's affected, physical, department store and apparel retailers, and the opportunity that those falling commercial rents create for new businesses. And so we're involved in a really exciting company called Museum of Ice Cream, which is opening a flagship location in a 24,000 square foot building on Broadway in Soho between Prince and Spring. And for people that are familiar with that block, it's two doors down from Dean and DeLuca, which also just went under on that. It was kind of an iconic corner there, that Dean and DeLuca space. So, Museum of Ice Cream is a ticket-based revenue, is the ticket-based business model. It doesn't have anything to, it doesn't rely on retail. Retail margins are generally pretty thin. Museum of Ice Cream margins are extremely high, and you just have a new business that can fit into this space. We also have a company that we're bringing to market next year, which is a membership club called High Court, which is about 6 blocks down on Broadway from Museum of Ice Cream, and kind of Broadway just south of Canal Street. And High Court is a 30,000 square foot membership club, and we're leasing the entire space. So that's a membership based model where people will pay monthly but commit to an annual commitment, and it's priced about the same as what Equinox charges, but it's more of a Soho House type of offering with fitness elements and health and wellness elements kind of on 5 floors. So that's something that we're super excited about. Because, one of our companies is taking down a 24,000 square foot building that used to be an H&M. Another one of our companies is building out a 30,000 square foot building. And they're both on Broadway, which is, kind of the center, the beating heart of, New York City, right? I mean, the High Court building was built in 1875, and we feel very privileged to be able to have a business that can inhabit that historic space. And new business, entrepreneurs that have had this insight for the particular business, but can take advantage of the market opportunity with falling commercial rents. Look, those types of businesses are starting to Elizabeth Street, but they kind of fall between, they're kind of just outside of what traditional tech VCs are typically looking to find, and they may be more appropriate for private equity firms, but because these are startups, it's, they're still too early for kind of more traditional private equity funding. So, for us, that gets us super excited. And it's also it's a very New York based thing because we're starting here, but, that trend of falling rents and, turnover of physical, apparel and department store retail is something that's happening globally. So we've got a real opportunity, and it's a trend that we're super excited about.
No, that's awesome. That's really cool. I still haven't visited the Museum of Ice Cream in LA, but I plan to. What's one thing that you would change about venture capital?
I wish there were more avenues for liquidity. I wish there were more outcomes, for an exit than just an acquisition by a strategic or an IPO. And I'm very interested in this long-term stock exchange concept. I'm very interested in, are there other paths to liquidity for some of these private businesses that don't necessarily, want to go trade publicly on the NASDAQ? So I'd say if there's one thing that would, improve our probability of success and also make it be another avenue for entrepreneurs that are running and building private companies, is there some either long-term stock exchange or is there some other avenue for liquidity? I mean, obviously with what happened with SoftBank's Vision Fund, that was trying something one way, and we'll see if that's viable after the WeWork thing. But is there another? I would change, because right now, as an early stage investor, our two paths, our main path is strategic acquisition. The second path is IPO, and what I would change is, maybe there's this long-term stock exchange is a potential third path and avenue for longer-term oriented investors to, with a different liquidity profile to access some of these later stage companies, but not have the burden on these companies to go public at that point or in effect a total sale. It would give early stage investors like us some path to liquidity, and those avenues exist through the secondary markets. So maybe it's just continued development of what's going on in the secondary markets and a way to access those in a way that's a little bit more transparent and available to private companies.
That makes a lot of sense. What's one of your favorite books that has impacted you personally and one that has impacted you professionally?
That's the easy one. To me, Joseph Campbell's Hero with 1,000 Faces is one of the books that probably impacted me personally the most. It was probably one of the reasons why between my stint living in San Francisco and before moving to New York, I actually ended up backpacking around the world for almost 2 years, and somewhat inspired by Joseph Campbell in that book, which was given to me by my father, so it had special meaning. Professionally, I think I mentioned, I read all David Swensen's books when I was getting my early career start, and I'd say, Pioneering Portfolio Management, probably by David Swensen, who manages the Yale Endowment. I wouldn't have gotten into hedge funds, and I wouldn't have gotten into venture capital if I hadn't read that book and studied what Yale's endowment was doing in kind of alternative asset classes like PE, VC, and hedge funds. So definitely that book professionally has had the biggest impact on my career path.
So what's one company that you recently invested in or worked with that you're really excited about? So,
well, we mentioned Museum of Ice Cream, so I won't say that one. We just announced today that we participated in Current's Series B round. We had also invested in Current's Series A. Current is a fintech company, and it's a great example of the scope that we're looking at everything from fintech to healthcare. And so Current is a neobank. They started with a banking product which was designed for parents with teenage kids to get them banked. But then also they launched a personal debit card product this year, which has taken off and grown extremely fast. The company has surpassed 500,000 users in total. We think there's a huge opportunity to provide better banking services to that middle and lower income tier of people that, shouldn't necessarily have to be paying late fees and getting, charged gratuitously for overdrafts and having gas holds put on their cards when they want to fill up their tank, especially if you're an Uber or Lyft driver or people that just are living paycheck to paycheck. Current allows them to receive their paychecks 2 to 3 days early, which is a huge difference if you need the cash early and you're living from one paycheck to another, or if you have lumpy income, or if you're working in the gig economy. So Current is a banking product designed for this next generation of people working in this gig economy. A lot of the current users are food delivery people, or they work for retail chains, or they drive for Uber and Lyft, or they do consulting businesses. And so they have a regular and lumpy income. And it's something where I think it's a great product. It's an excellent team founded by Stuart, who is a former FX trader, and was thinking about future of money. And we saw it and we were thinking about, wow, like this is really, for Elizabeth Street that focuses on digital commerce, these next generation banks that enable digital consumerism essentially and digital banking are, integral to that. And so, a huge part of what we're doing thematically, but then also, massive market. And, acquiring, you don't have the infrastructure that legacy banks have, like physical bank branches. And if you're designing a bank from scratch today using technology and building all the back end things in house, like you have a lower cost. You can be a lower cost provider of banking services. And so that can allow you to do some things that these traditional banks just cannot do structurally. They're not set up that way. So Current's a super exciting platform to offer different banking products to consumers like in Gen Z and millennials that just interact with money now in a completely digital way, right? So when I was young, I had a passbook for a banking account and I had a lot of, piggy bank with cash. And, going forward, I don't think kids are going to be, saving in bills and coins. I mean, it's all digital. So, what's going on in digital banking with Current and, some of the competitors is super exciting. So yeah, that was one that, the Series B, which was led by Wellington, was announced today, and Elizabeth Street, did a follow-on, with lead investor, Expa and QED, who are great firms. And QED is one of the most highly regarded fintechs out there. And so for us to co-invest in a group like that, I think is super exciting for Elizabeth Street.
I actually didn't realize that you're in the Series B. I just saw that you're in the Series A. So that's even more exciting. Congratulations. That's really, really great. So what's one company that you had the opportunity to invest in, didn't, and wish you did?
So I don't like to play Monday morning quarterback because, it can go either way. But, the one I always think about is Daily Harvest. And we met Daily Harvest at the seed stage. I mean, it was super early. Yeah, I was working at the family office and I just thought it was super interesting. But, the family office I worked for, was very focused on CPG distribution and the food distribution is a completely different animal. And so, the thought process was, look, it's food and, that's not really a focus of ours. And, I just thought that would have been an interesting one to do because the value proposition, the product offering and shipping frozen foods, healthy smoothie, in frozen cups to people all around the country that didn't necessarily have access to, places like Juice Press and places like that made a lot of sense. Thematically, like, people want to eat healthier and, being frozen means that it's super convenient. And people that don't live in small, tiny apartments in New York, like New York, actually have, big freezers. And, so frozen food can actually be a really healthy and easy and accessible way to buy and consume food. And so I thought Daily Harvest was super interesting. And we saw that at the seed stage and didn't do it. And, for everything I've heard, it's done phenomenally well. So not being able to go back in time and do that one, we just led the seed round for a frozen organic direct-to-consumer baby food company called Tiny Organics. So a lot of similarity. It's like, so my thought process there was, look, I missed Daily Harvest. But, when those consumers of Daily Harvest have kids, they would be very, natural customers for Tiny Organics, which is similarly frozen, fresh, organic, direct-to-consumer food for toddlers.
Well, I know it always, is never good to be Monday morning quarterback, but if it's helpful, I had Susan Line on here from BBG Ventures, and she actually mentioned Daily Harvest. Well, Daily Harvest was the answer for this question as well.
Yes, she did.
And I had
oh, that's interesting. And Susan's great. I love Susan. I think what she's doing is phenomenal too.
Yeah, no, exactly. Well, Will, this has been phenomenal. Thank you so much for your time. I really appreciate it.
No, it's been great, and thanks for including me. And it was great speaking to you. And I really enjoyed, my time talking to you.
And there you have it. It was so great chatting with Will. I hope you enjoyed it as much as I did. If you want to keep up to date with Will, you can catch him on Twitter at data_01. It will also be located in the show notes and on the website. You're also welcome to check out theconsumervc.com for all episodes. And if you want to follow along behind the scenes, feel free to follow me on Twitter at Mike Gelb and at ConsumerVC. Happy holidays, everyone. This is a final episode of the year, and I'm going to be taking a 2-week break, and we'll be returning to the mic January 6th. Lots more content to come in the new year, and I'm very excited to share more of these conversations with all of you. Once again, happy holidays, everybody, and be safe.